Let us take a look at the notion of profits. In economics, we differentiate accounting profits and economic profits. Accounting profits are revenue minus explicit costs. Explicit costs are direct expenses that require direct money outlay. There are clear records of transactions. These costs include wages, insurance, taxes, electricity bills, etc. Economic profits are different from accounting profits in that it includes all costs, explicit and implicit costs. Implicit costs are the opportunity costs of owners' own resources that could have been rented elsewhere and could have gotten rental value. What is the owner's time worth when he's in the business after hours? All these extra hours of work could have been used elsewhere and could have gotten some remunerations. So it's possible for a firm to be earning positive accounting profits, but economic profits may be zero or even negative. Zero economic profits means your accounting profits are equal to your opportunity cost of the owner's resources. Negative economic profits means the owner, the entrepreneur, and his own inputs could do better elsewhere. Total revenue is price times quantity. Now, from total revenue, subtract accounting costs, we get accounting profit. Take the accounting profit and subtract implicit costs, we have what is called the economic profit. So economic profits are always smaller than accounting profits. So here is an example of how to calculate economic profit. Suppose revenue from sales was $100,000 minus the cost of labor, these are all explicit costs, capital, land, raw materials, etc. $70,000. So pre-tax accounting profit is $30,000 minus taxes on accounting profit is $10,000. The residual is called accounting profit, which is $20,000, minus normal profit, that is the value, rental value of owner's own resources like capital equipment, etc. $15,000 minus the difference is $5,000. If this is positive, that's economic profit. If it's negative, we call it economic losses. Next, consider a long-run equilibrium. The long-run equilibrium allows free entry and exit. Long run means all inputs are variable. In addition, the number of firms is also variable because we allow free entry and exit. So if industry profit is positive, there will be more firms in the next round. If industries are experiencing economic losses, some of the firms will exit. When the dust settles down and no more entry occurs or exit occurs, we have long-run equilibrium. Profit is equal to average cost. No one has an incentive to exit the market or enter the market. So long-run equilibrium is characterized by zero economic profit. So this diagram illustrates industry's response to a positive profit. Suppose price of the product is above the minimum of average cost. The representative firm is earning profits, so more firms will enter the market, shifting the supply schedule from S to S prime. As entry occurs, more firms enter the market, the supply curve shifts. The supply curve shifts to the right. This rightward shift continues until price falls to the minimum of long-run average cost, and that is when entry stops. So this table explains the process of equilibrium. If economic profits are positive, more firms will enter. The number of N goes up, and market supply increases. As a result, market price falls, and economic profits fall until they reach zero economic profit. Once profit is zero, no firm has an incentive to enter the market or exit from the market. Okay, here is a question. Which of the following is true about the long-run equilibrium in a competitive market? All firms are earning positive economic profit? No. All firms are producing a unique good? Not necessarily. They are all producing homogeneous products. All firms are content to stay in or out of the market. Yes, that's true. The number of firms is stable. Next, consider the impact of a change in industry demand. Suppose competitive firms are earning zero economic profit, and if there is a demand shift, the equilibrium price will change, and the number of firms will change, causing an entry or exit of these firms. So we'll consider this process. Suppose the industry is in equilibrium, in long-run equilibrium, and market price P1 is at the minimum of long-run average cost. And suppose that there is sudden increase in demand, which causes demand curve to shift to the right. As a result, market price rises to P2, to this level. Well, every firm is earning positive profit, so the number of firms N will increase, thereby shifting the supply schedule, market supply schedule, to the right. This rightward shift of the supply schedule continues until a new equilibrium price equal to the old equilibrium price is reestablished at P1. Next, consider the impact of the changes in input costs. If firms' production cost increases, some of the firms will leave the industry. So let's consider the impact of an increase in input costs. So initially, long-run equilibrium is attained at the bottom of average cost right here, and suppose these firms are importing resources, rare earth minerals from China, and their input prices are going up. Well, that's going to raise the average cost curve upward, so the new long-run equilibrium price is P2, and as a result, as the input prices rise, market supply curve shifts upward or to the left. So when new firms enter, it may affect existing firms. Their production costs might change. Their production costs could remain the same, or it could increase, or it could decrease. We'll consider these three different scenarios. A constant cost industry is an industry in which the production costs of the existing firms are not affected by entry of these new firms. So as the industry expands, as the industry output expands, the industry requires more inputs, but wage rate and rents remain constant. In this case, we observe a constant cost industry. As the industry expands, it has no effect on the input costs, and therefore the average cost remains constant. But in some industries, as industry output expands, input costs go up, like imported inputs, rare earth minerals. Their prices go up, and as a result, as industry expands, production cost rises. AC rises. So in this case, we observe an increasing cost industry. That is, the industry supply curve is positively sloped as output expands. So agriculture, farming sectors, generally a constant cost industry within a range. In most other manufacturing industries, using imported inputs, for instance, cost curve may be rising as industry output expands. So the industry supply curve is positively sloped. In very few industries, such as TV monitors, industries producing TV monitors such as 8K, 4K monitors, and TV sets, prices have been going down and the quality has been doubling every few years. So this is a case of a decreasing cost industry, in which case long-run supply curve is negatively sloped. Okay. So these monitors, flat screen monitors, flat screen TV sets, 8K or 4K monitors, the industry cost has been declining. So here are the three cases. Long-run industry supply curve could be horizontal. That would be like in agriculture. In other manufacturing sectors, long-run supply curve is positively sloped. In a very small number of industries where innovation-intensive industries, long-run supply curve may be negatively sloped. There are two notions of economic efficiency. One is technical efficiency, meaning industry outputs are produced at the lowest possible average cost. Allocative efficiency means price equal marginal cost. Okay, here are a couple of questions. In perfect competition, an increasing cost industry results in a upward sloping, like this. Upward sloping long-run industry supply schedule. Next, technical efficiency in a market means output is produced at the lowest possible average cost.